Hello friends, welcome to the paper review of SFM November 23 exam, CA Final SFM exam. I'll not take much time, dive right into it. On an overall basis, this particular paper is, if you ask me, is about I would say on a scale of 1 to 10. I think it's a paper which is 10 being the toughest. This paper is close to about 6 or so is what I would say, because I don't think it's a very tough paper, but at the same time I don't think it is an extremely easy paper also. I would think that this is a paper that would someone who's prepared well would definitely be able to do. Right. And I honestly believe that students who have taken from us, classes where I have taught, should not ideally face a problem. There are one or two problems which are tricky. I will explain that also. I will not go into detailed solutions because now is not the time. You guys are supposed to prepare for your next exam, which is day after tomorrow. So please don't, get into the solutions. But on overall basis, I believe that this particular paper was fairly, it's a moderate paper. I wouldn't say it is a very easy paper. At the same time, I wouldn't say very tough paper also. The reason why I'm not saying it's a very easy paper is there are some small tricky adjustments which the institute has now become very, very famous for, especially from the last 3 attempts. So if you look at the first question, this is a question from the derivatives chapter. An investor has a portfolio with a certain number of price, shares, and beta, and they've asked us to do what? Compute the beta of the portfolio, and they want to figure out how they can hedge it using Nifty futures. Now, this is a question straight. Right, the number of contracts of Nifty investor needs to sell to fully hedge until November for his portfolio. This is a question straight from derivatives chapter, question number 11. This is question number 11 from our compiler. So those of you who have access to my compiler, please go and look. We have solved this in the class. This is question number 11, which we have discussed in the class in derivatives chapter. It's a basically the futures and forwards portion of the derivatives chapter. And it's a very simple question. It is straight out of that particular compiler. I think one or two small, very small minor adjustments, but other than that, it's a very, very simple straight question. Now, coming to the next one. This is a question from portfolio management chapter, and this, believe me, my friends, is a straight question. There is actually no change in this particular question from what is there, what we have solved in the class. This is question number 52. Question number 52 from the particular chapter of portfolio management. Question number 52 of portfolio management chapter. You can actually go and look it up in the compiler, and you'll actually be able to see that. Now, this is a very simple question where they've talked about arbitrage pricing theory. This kind of question has not been earlier asked in the exams. It is being asked now. So, it's a good thing. I actually believe that the institute, one thing that they've done in this particular attempt is that they've actually gone ahead and asked certain questions which they've never asked earlier. So to that extent, I would say this is not necessarily a super easy paper. There are some elements of, they've brought out certain twists and they've really genuinely tried to make a certain attempt instead of saying that, all the questions are directly from the study material. They've tried to make certain twists and turns. Even in the theory questions, they've done that. I will show you that. Right. Then, lack of existence of a well-developed debt market is an obstacle that hinders growth of secondary market or securities or asset-backed or a secondary market of securitized or asset-backed security. Is it true? What are the problems in securitization? So this is a good point. It's just about what are the problems in securitization. So it's a fairly simple question, and I've specifically highlighted that this is a very important question. In my compiler T290, what I've shared, also I've highlighted that. Coming next, this is a question from I think this is a question specifically from the futures and options chapter, derivatives chapter, from the options section. And this is also a very, very straight question from what we have solved. This is question number 10. You can see here, this is question number 10 in from options chapter. Absolutely ditto. They've given the current price, strike price, minimum expected and maximum price. You have using that, you have to calculate call option value by using both binomial as well as risk neutral method. This is a very, very straight question. Then coming to mutual funds, this is a question from mutual funds, and this is a mix of 2-3 questions, or this is very similar to 2-3 questions. I'll say question 10, 11, and 30. This question is not a, we don't have in most of the other questions. We used to have the amount of investment. Amount of investment was there. This is questions 10, 11, and 30. If you see from my compiler, what is freely available, 10, 11, and 30, amount of investment was there and other details were there, and you were supposed to find out some other data points. Whereas here, they have not given the amount of investment. Anyone who's smart, who's understood the mutual fund chapter, who's gone through what I have actually taught in the class will be able to solve it. It is not a twisted adjustment. It is a simple adjustment. Do not overcomplicate life. This is not a complicated problem. It is a simple problem only. I have explained to you what is effective yield per annum. When you compute yield, how do you do it? All of that. Now, coming next, this is the tricky part. This is the theory question. They have asked conversion factor in interest rate futures. Please note conversion factor, cheapest to deliver bond, and all of that. We have discussed this in this particular chapter. Then Vega and Rho. Vega and Rho, volatility and risk-free rate. Those are the components, or those are the factors which affect the option price, the rate of change in the price of an option due to change in volatility or due to change in the risk-free rate. That is Vega and Rho. So this was never ever asked earlier. We used to have all very, very similar kind of questions in the past, but they've actually asked this in this particular, in this particular attempt. Then next question is again a practical question, question 3A. This is from, this is very similar to question number 2 and 32. Yeah, I've already written it here. Question number 2 and 32 of our compiler, where we have actually considered, this is a question from which chapter? This is security valuation chapter, and where it is a rights issue related question, where they very specifically asked what is the change in wealth if he subscribes or doesn't subscribe. Calculate the ex-right price is a very simple question. There is nothing. This is a full task question. Okay, if you ask me, this is absolute full task question. You should have solved it. Then comes next question, which is question 3B, which is from Forex chapter. This, my dear friends, I would say is a slightly tricky question. This is a slightly tricky, but we have solved very, very similar question number 74 and 75 in the Forex chapter, where this is an integration of Forex plus derivatives. So where you actually have call and put option and bunch of other stuff that we actually discussed about, where you actually have call and put option integrated into a into a Forex related contract decision making question. So this is actually a fair question. This, if you ask me, is a slightly tricky, but it is very, very similar to 74 and 75, what we have actually seen. Right. And here you need not have both call and put. You have to decide which one you have to do, because they are actually trying to hedge. There is a import from US of 1 million. So you are actually having to buy dollars and sell yen. So you have to figure out what kind of an option is required. Anyway, moving forward, main features of main function of corporate level strategy and 3 basic able questions you should be able to answer. This is also a simple question. We have done this I've explained this multiple times. Then coming to 4A. This is from M&A chapter, and this is very, very simple question. This is again a full task question. Question 23 and 24 of M&A chapter. Straight, very, very simple. I have explained what is free float market capitalization. Basically, the holding that is not with the promoter. Right, and then you are supposed to calculate swap ratio based on 3 weights that they have given, 20, 60, and 20. It's a super simple question. There is nothing very fancy about it. In fact, all the rest of the aspects are also very, very simple. Next, coming to next question, which is 4B, which is on interest rate risk management. And this, my friends, is about the cheapest to deliver bond and conversion factor. So the theory question, what they asked there, they have asked the practical aspect. This is I think this is one of the first times that they've actually asked this. We have this particular question also, I think question number 6 and 7 in the interest rate risk management chapter we have solved. I have explained to you what is cheapest to deliver. In fact, I put in extra effort to figure out how this works. I've given you questions from CFA Institute to figure out how this works. So 6 and 7 from the compiler, please go and check it. If you solve those two, you'll be able to solve this particular problem. This also, if you ask me, is a slightly twisted one, because this was never been asked. Next, 4 methods of identification management of financial risk. What are the parameters to identify currency risk? This is also from risk management chapter 2. It's a theory question. Then import customer booked a forward contract exchange rate for dollar in interbank market. Then this is a fate of forward contract. Question number 87. We have solved this. This is ditto. In fact, the numbers have changed. Of course, the numbers have changed, because I think the rates that I've considered there are 60, 70. This is so unfortunate, no? They have given rupee dollar exchange rate as 48, 49. Kya was rupee is at 83. You should at least give questions that are relevant to today's day and age. You cannot say rupee is at 48. That is in my childhood. When I was doing derivatives hedging in my old company. This was in 2011, 12, 13 and all. Anyway. This is a fate of forward contract. This, if you have understood fate of forward contract, you'll understand. This is a 87 question number from our compiler. It is a simple question, just that you have to know how to solve it. This is not a twisted or complicated question at all. Then next one is portfolio management. Here they've asked you to compute beta. So for a BSE Sensex changes 25, the stock changes 32. So what is actually the beta? Right, the sensitivity of the particular stock to change in the index is beta. So you can actually compute it. This is question number 57 from portfolio management, 57 in our compiler. This is from portfolio management chapter, and you're supposed to figure out the security market line. The security market, you're required to calculate the security market line. What is security market line? CAPM model. That's all. Nothing. The formula for CAPM. You don't need to do. And alphas of two stock based on sharp index model. This is also apparently there in the question. I think this is also there in the question. Okay. Next. This is a theory question on startup, and they've said, currently the turnover is 500 million or 50 crores. Okay, so you have to figure out whether this falls within the limit or not, and then you have to go ahead and respond to this particular question. This is a good, if you honestly ask me, this is a different type of question, but I don't know why they have so much theory, but that's a different conversation altogether. Next, 6A. What is 6A? This is from corporate valuation, question number 33. This is again a ditto question. Only the names have changed. Same question, names different. Okay, this is a very, very similar question on economic value added, what should be considered best for investment. Very, very simple question. This is a corporate valuation. This is again a full task question. This was not at all a tough question. Okay, then, so you see what they've done, brilliant twist, or at least what it appears on the face of it. They have every question, they've given one tough part, one easy part. So the first one, previous part was easy, second part is tough. This is a question from interest rate swap or interest rate risk management chapter, question number 17. Right, previous one was question number 33. This is question number 17 from interest rate swap, and this is not a complicated question. It appears complicated. So there is a generic swap for LIBOR flat, notional premium is so much, and interpret the dealer code 8%, 8.2. So please note, all of you who remember BBBBBC. Banker bids to buy the base currency. So bid is always what the banker will do. Ask is what he will basically sell. So you have to figure out what part, 8 or 8.25%, which is relevant for this particular. If bank is quoting this, what is it for you? What is it for them? If they are giving you a swap, it is always costly. If they are buying a swap, it is 8%. Right. It is a very, very simple thing. It is, I won't say extremely simple, but I would say definitely if you understood the concept of interest rate swaps, you will understand what this is. And they've given semi-annual payment, 6-month period, effective date, 330 by registry. They've given everything. I've told you also multiple times, they will give you the notion, the convention which you have to follow. They've actually given. So honestly, if you ask me, this is a good quality question if you ask me. Right. Then, in a rational, well-ordered, efficient market, technical analysis may not work well. Is it true? List out reasons for this about technical analysis. This is again security analysis chapter. Simple. In deal structuring, many structures to facilitate the exit, the VC may put a tag on clause. What do you mean by clause? Explain deal structuring and exit plan. This is from startup. So this is also easy. This is also not such a tough thing. So on an overall basis, right? Overall basis, I would say I would rate this as 6 out of 10. 1 being easy, super easy, and 10 being super tough. I would rate it at 6. The reason is there are good quality questions in this. This is a good quality paper, and this is unlike your FR paper which came day before yesterday, which was all chaos, where every question had some really stupid twist or weird twist. And this is not a question that you should, this is not a paper that you should lose sleep over. Students who have taken classes from me, who have, gone through all the questions, all the 500 questions, what I've solved in the class, who have gone through, I'm fairly confident they should get 60 plus or easily, very easily about 60 to 70, in the 60 to 70 range, very, very easily. Okay. If you have done very, very well, I'm sure this is a paper where you can get 80 plus or even 90. Okay, but on an average, if you have done well in my classes, I am pretty sure you should get 60 to 70. However, there will always be certain circumstances which may not go well. But anyway, this is the review of this particular paper. I strongly suggest you go and study for your next paper, which is day after tomorrow. Okay, so that's the session, guys. Please, please study well and all the very best.